How do stock markets react to an election? This is a question we hear regularly, typically every 4 years. And the good news is that there's enough market history that can give us investors a pretty good understanding of what to anticipate, even if every election seems to be unprecedented lately. The S&P 500 index history goes back to 1923, giving us 24 election years worth of performance to work off of. The great news is that markets are typically positive, regardless of the outcome of who is elected. Of course, past performance can't guarantee what the future results will be, but can help us build an understanding of what's occurred. Beyond an election year, how should we prepare? That's often a concern. One political party president may have better performance than another. Not surprisingly though, markets have performed well under both Republican and Democratic presidents, and have risen under every president besides Richard Nixon and George W. Bush. Keep in mind, the S&P 500 is a group of large corporations within the United States, not the political party in power. Another consideration, what happens with Congress? Given a variety of combinations of House, Senate, President, stock markets still see an upward momentum, often regardless of controlled or divided governments. The biggest thing to your investment strategy is ensuring that your viewpoints are set aside. If you stay invested only when your preferred political party is president, research has shown that you are significantly lowering your returns compared to those that stayed invested during all presidencies. Moving in and out of the stock market based on who won the most recent election will end up hurting your portfolio more than staying the course. Election years can cause some volatility, but overall markets have risen historically during each year of a presidential cycle, including election years. The circled year 4 represents an average market return for a first-term president in their 4th year. Of course, election years are stressful times, and changes in who is in office can impact our futures. However, markets are more likely to move to economic and market factors like interest rate policy, economic data being reported, unemployment numbers, and inflation numbers, as well as corporate earnings, to list a few examples. Instead of trying to time the market or make any big market bets, data shows staying diversified and sticking to your financial plan is the best path for continued success. Refocusing on what the reason for investing was in your financial plan can help ensure the risk that you are taking on is appropriate. Take advantage of our free financial assessment at Pure Financial, where you can talk with an advisor about your goals and risks to find out if you're allocated correctly for the election year and long term for your retirement.